Hey everyone, welcome to another edition of our Smart Investing Weekly Stock Analysis, where we take a closer look at those companies you may be hearing about in the news, maybe companies that you're curious about and investing into. And this week, what we're going to do is we're going to take a look at this little known company called Apple. I'm sure we've all heard of the company, but if you find the analysis interesting today, you're interested in further analysis that we have done or are going to do, be sure to hit that subscribe button below so you can get notified about our future videos. With that said, let's get into the video here today. Let's talk about that little known company called Apple, and we'll have a little discussion about it first, and then we'll take a closer look at numbers as we always do with the fundamental analysis.
And Chase, Apple is probably one of the most well-known companies. Everybody loves Apple. It's a great business. But the thing investors have to realize is what you're paying for that investment. I know what people are saying, oh, Warren Buffett has a lot of it, and he does. But if you go back in his history, there are times, and I forget the name of the company off the top of my head, but there's one that was similar to Apple that went way up in price. Then I came back down, and he said, I wish I would have sold that high price. No matter what the company is, nothing goes to the moon. And there's so many things with Apple that could cause problems. It just, if somebody comes to us, I had somebody on social media ask me, should I sell Apple? I won't tell them, yeah, because I'm going to say at the end here, but I gave the answer. And people probably don't like the answer, but I mean, you've got to be truthful. You got to look what you're paying for any business, no matter how great that business is, something can go wrong. And then you can't say as an investor, like, no one told me. You knew that you had a company. It was very, very pricey.
Yeah, and I'm thinking today maybe we switch things around a little bit, because most of the time we talk about what's going on with Apple. Most people know Apple and the business and kind of what's going on with the company. So I think maybe let's take a look at the numbers first, and we'll have a further discussion around what's going on with Apple and kind of our opinions on it. So with that said, let's take a closer look here at the numbers. As always, we want to look at what's going on with the company, what's going on with the valuation ratios and so forth. So let's see here. We want to come to share my screen. Sometimes you got to get the technology squared away. There we go. All right.
There we go. And one thing we want to say as well is that when we talk about these, it could take weeks, months, sometimes years before things come to light about what we talk about. But this is what it is, owning a business. So
did you say weeks? There's no way it takes weeks. It takes months, quarters, years. Well, I'm never going to quote in terms of weeks.
Well, no, I'm saying that if actually we say that Apple is, too pricey, it needs to be sold, yeah. It's going to drop. It could drop in weeks. I don't think it's going to happen, but it's possible. So I'm just trying to let people know that it could be weeks, months, years is probably more important. But you never know. That's the thing. You can't hold these high-priced companies. Let's move on. Apple is in the consumer electronics industry. No one wants to short this company, 0.7%. This is shocking to me. 59.4% institutional ownership. I'm just one off the top of my head. Is Berkshire Hathaway not considered institutional? I would think it would be, but gosh, less than 60% institutional. That's surprising. Now, that could also be worrisome because of the fact that if you have a lot of individual investors holding that, they could panic and sell this very quickly, causing problems. So that's why we look at institutional ownership. Could be a problem there. Let's look at the valuation ratios here. PE ratio 28.9. That is above the high PE ratio of the industry at 26.9. Price of sales 7.7. Also expensive to the industry at 4.8. And again, valuation ratios, you want them lower than the industry average. Looking at the price of tangible book value, 39.6. That's below the industry, which is over 100. But still, you're not getting anything on sale at 39.6. And price of cash flow, 25.9, above the industry at 23.4. And it's got a nice PEG ratio, 2.0 versus 19.5. So that is one positive for them, that they think there's a lot of growth going forward that you're not paying much for now. Let's look at the earnings over the last year. They are up 34.9%, about the same as the industry at 34.3. And even the 5-year, 23 versus 24. Now, this is kind of concerning to me because you're not getting more in earnings growth in the industry, but yet you're paying a big premium. That to me is a warning sign. Take a look at the sales. They don't look very good either. I'm looking at it. Sales are up 16.3%, below the industry at 22.1. And the 5-year 11.4, also below the industry at 12%. So I'm scratching my head. Why are we paying such a high valuation for this company when they're not doing much better or better than the industry at all. Look at the dividend yield. Oh my gosh, now 0.5%. They only use 14.2% earnings to pay that out. That's okay, but they used to have a decent dividend. We do see that we have a 5-year average growth on those dividends of 9.1%, below the industry at 9.4. We do see on the balance sheet got a current ratio of 1, below the industry at 1.1, debt to equity 1.7 versus 1.6, and this is you want lower. It's 170% versus 160%. Not good there either. Let's look at some other things here that maybe could be good. Days inventory 9.9 versus 14.5. We do see a net profit margin. Only good number I've really seen, I feel great about. 26.6 versus 17.7. A very good profit margin for the company. Return on the equity. Well, these look strange. 139.8 versus 133.8. That just seems very strange. Now, they could have very low equity with high returns, but very rarely do I see that type. And I also am kind of wondering here, is it possible that Apple, because they're so huge market cap wise, perhaps they take up a big part of the industry? So you're really not comparing to the industry, because Apple, who knows, maybe makes up 40-50% of the industry. That's not a good comparison. That worries me too. So, and we've not looked at Apple in a while. I'm seeing a lot of things here, Chase, that really concern me, but I'm gonna let you go forward, see what you come up with.
Yeah, I was just kind of scrolling back up to see again that industry. It's consumer electronics, as you mentioned. I'm curious what else is in there, because that's a great point. I mean, if they do it market cap weighted, and Apple, you can see near the bottom of the screen here, their market cap is nearly $3 trillion. If they're comparing against other companies that are 100 billion and the whole industry's worth $6 trillion, let's say, well, all of a sudden that industry average is 50% Apple. So that's something that's a great point you got to be cognizant of. Now, let's take a look at the numbers here. Current price for Apple, $174.31. Back near the 52-week high of $182.94. 52-week low I see here, $122.25. I see the year-to-date return, not bad, down 1.7%. Again, you look long-term for Apple, 10-year return, it's done phenomenal. We know Apple has been a stock darling, I'll call it, over that period, up 834%. Not surprised to see those big return numbers. Important though, we always tell people, past returns are no guarantee of future results. Just because Apple did great over the last 10 years doesn't mean it's going to do great over the next 10 years. You have to be very careful doing that. And we've seen that happen time and time again, where the big dogs don't stay on top forever. This is what concerns me. I go forward for Apple. I'll go out to September 2023. I see estimated earnings per share of $6.55. Would give us a target sell price of $108.73. So again, this company's trading for 26.6 times the future earnings. And you see here, trading at that high of a multiple, you're getting 6% earnings growth next year. That's not worth, in my opinion, 26 times future earnings. If I'm paying that high of an earnings multiple, I want a company that's growing earnings on a rate of at least 10-15%.
You know what worries me, Chase? A lot of people think, oh, it's Apple, it'll be fine, and so forth. Those are some very dangerous words when it comes to investing, because you've got to have the growth. You've got to have, you can't be overpaying for these businesses. And again, we don't know when, what's going to happen. We do have the crystal ball here in our office. See if I can show you. Yeah, see, there's a crystal ball. Doesn't say too much about Apple, but you can't depend on these things. And I know, as I said earlier, Warren Buffett has owned a big portion of this. Perhaps he can't get out of it because he owns such a big portion. So he might be sitting at home thinking, what do I do? What do I do? Because I can't sell this. I know it's overpriced. So little investor, they have the advantage over Warren Buffett right now because they can get out and not move the market.
Yeah, and the other thing you have to realize too is, again, the S&P 500 market cap weighted index. Apple is the largest company now in the S&P 500. I think it occupies over 6% of the index. So that's one thing too, is people buy the S&P 500, that really tilts towards increasing the share price of Apple as well, because then you have to buy 6% of Apple. But it can also happen on the downside, where people start selling the S&P 500. Oh my gosh, Apple starts to go down because you have to sell out of Apple as well. People then start selling Apple. It creates this kind of snowball effect. And especially, I hate to say it, but the retail investor, they're very, very fickle. When things change, they don't know why they're changing. And they say, I'm just going to cut my losses. I'm going to get out before I lose more money. It can create some big, big problems for a company that's of Apple's size and that does have that much retail ownership.
We don't have time to discuss it here. We discuss on our radio show and other posts and so forth, but there could be a recession coming up. We're seeing that inverted yield curve. If that happens, people start panicking. They could start selling their index funds. I mean, Apple's has to be sold. This thing could fall apart, and you don't want to be the last one at the party. I mean, it may go a little bit higher, but you're at a very expensive party right now, put it that way. And if you're the last one there to turn off the lights, it's not going to be pretty for you.
Yeah, and I do want to mention as well is we talk about stock buybacks, and Apple's been a huge benefactor of stock buybacks. I'm going to go back to the earnings per share growth versus the sales growth. One reason earnings per share has grown so much faster than sales growth is because of all the stock buybacks that they've done. But years ago, Apple traded for 10, 12, 15 times earnings. They were buying back a much larger share of the company than they are now at a $3 trillion market cap. If they're doing, again, I'm just pulling out a number, let's say $10 billion of stock buybacks, that's not even moving the needle. That's not going to help with earnings per share. That's why I'm a little bit cognizant. I know we said that 5-year estimated growth was, I think, about 14.9%. I don't see where that comes from. I mean, you talk about all the other businesses Apple's getting into, even if they get into, let's say, streaming, they don't have enough in sales of streaming or earnings that come from streaming to even move the needle in terms of their overall sales. It's just the company has gotten so large that now creating new revenue streams, creating new earning streams, it's so hard to create that growth because the company is so big.
And Chase, that's a great point about the stock buybacks. And these are things that people don't think about. I've been in the industry for over 40 years, and you've not been doing it for, gosh, how many years you've been doing this now?
About 10.
About 10. And by the way, today's your birthday. So
Hey, add another year. Yep.
So, but again, you pick up these things, you learn things that many times the investor that's not paying attention doesn't. And I have seen this happen over and over again for people. Like, I don't know why it fell apart. We got the Nifty 50, the tech boom and bust. All these things happen because people take their eye off the ball. And I know it's not popular. Our decision right now is not popular, but we're looking at the value of something. Things we bring up again about the comparison of the industry. We bring up about the market cap. We bring up about the stock buyback. There's so many things as an investor. You should ask yourself these questions. What makes sense to me? And then make your decision when you buy, sell, or hold it.
So. Yeah, and I don't want to spend too much time on this, but I have to bring it up as the other issue is China. You know, China is a big kind of positive light that people look at for Apple. And, you know, it's crazy. You look at the company Xiaomi and you look at the companies Huawei, you haven't heard as much, particularly about Huawei in the news and so forth. So I do not trust China. I don't think they want Apple to be the number one company there in the country. So you have to be very, very cautious of, you know, what's going to happen in China, and in particular, what's going to happen in China with Apple.
So many things we can talk about this company, but that's why we do, you know, these posts on a regular basis. We do the radio show, we do new social media, newsletters, many things for people. I know you'll promote a little bit more on that, but great company to talk about, but a lot of concerns.
Yeah, as I said, be careful. Give you some things to think about. Do more research on Apple, but we definitely do rate Apple a sell at this point, even if it is an unpopular opinion. But thank you for joining us today for our Smart Investing Weekly Stock Analysis. Again, if you found this information very useful, or you're interested in finding out more information about it, be sure to hit that subscribe button below, or you can visit our website, smartinvesting2000.com, for more information, other materials that we do provide to investors as well. Thank you again. Just as a reminder, this video is for informational purposes and should not be used as investment advice. We look forward to seeing you guys next week.
Have a good one.